Hi, everyone. Welcome to another Barometer Readings webcast. I'm Pamela Hastings and welcome you so welcomely to our webcast this afternoon. Joining me today is David Burrows, our Chief Investment Strategist and President here at Barometer Capital. We are going to talk about the markets, what's been happening over the last few days. We had some volatility and a rebound, and so Dave's going to walk us through that, as well as our current positioning, risk management, performance. We're going to set a lot of time today during this webcast to address your questions. So please feel free to email me at phastings@barometercapital.ca, or you can participate via the chat and I'd be happy to address them. So with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
Great, thank you.
Well, welcome everybody to another Barometer webcast this week. Different than the last several weeks. We got a little bit of bumpiness in the market, and we've talked about that over the last few weeks, the likelihood that we would have some sort of pullback as we got into late summer, early fall, because frankly, the market has been on rails and markets don't go straight up. So I wanted to talk about that a little bit today, how it's affecting portfolios, changes that we are making in portfolios, and how we address things going forward, should it get more difficult. So just quickly, always at the core of what we do is a focus on trying to do three basic things: to use the tools and the processes that we have to try and identify the core sort of market leadership themes, sectors or themes that based on current environment are being revalued positively, maybe have a structural tailwind, and are in the right place at the right time, areas that investors have appetite for. And we try and focus our attention in those areas. We really do try to be tactical. We really do try and pick our spots. At times, there will be big parts of the market that we completely avoid. And as you know, it's at certain points have cash. So our job is to recognize change, new leadership as it starts to emerge, and old leadership as it starts to wane. And then, of course, in the event that nothing's working, have an ability to be on the sidelines. So we take that tactical approach through all of the various mandates that we run, whether it's our equity mandate or whether it's our income mandate or balance mandate, long, short, or macro. And we use them all differently. Now, we have been in a structural bull market in stocks for several years. And there have been some big pullbacks along the way. We got big pullbacks in 15, 16. We got a big pullback in the fourth quarter of 2018. And of course, we got this very significant pullback in February, March this year. The NASDAQ has been the leadership. And in fact, over the last few months, the NASDAQ's performance has been extraordinary. We talked about the fact that things were probably getting a little bit overly exuberant and a little bit euphoric. And you want to take advantage of a bull market while it's there. But certainly when we start to come out of a range that we've been in since 2008 to the upside, it does speak to euphoria and a little bit of greed. And we talked about how there had been very, very significant call buying by small investors, people buying a call on shares at a fixed price in the future, making a bet that they will trade above those prices when the calls come due. And that there have been some significant statistics around that. We talked about some of the sentiment data that's been very, very positive. We talked about the fact that there is lots of cash on the sidelines that still can be brought to bear, and that's been used to buy dips, but that we were probably likely to have some pullback at some point. And that of our mandates, one of our mandates was set up to try and take advantage of a pullback, and that's the macro strategy. So very significant decline through February, March, very significant rally on the other side. This plots the recovery against all of the various recoveries of bear markets going back over the last 40 years. Okay, so what did we learn over the last week? In the last weekly meeting we talked about the fact that we have had such significant outperformance in growth and such significant underperformance in value. We were watching for signs that might start to revert. And over the last week, we have seen some improved performance in things like transports, basic materials, things that are more tied to the general economy, things that are more tied to a reopening, and there has been some optimism around that. Now, it's not all been good news over the last week, obviously. On the vaccine front, AstraZeneca ran into a hiccup in their trial and had to stop their trial, which is one of the most significant vaccine candidates. The Republicans and the Democrats have continued to be unable to get on the same page on a new round of fiscal stimulus. Significant distance between them. Even a skinny down bill that they tried to pass today was unsuccessful. You have had central banks in various parts of the world come out in favor of continuing to support financial assets with easy monetary conditions. That's positive. And we've had some good economic data. We certainly had some good employment data over the last 2 weeks in the US, employment certainly getting better. But markets have been a little bit sloppy. So I'm going to jump back and forth between some apps here and see if I can put some of this on the screen for you. So starting out with sort of the breadth work that we do, we came into the week, this past week, with some red signs in our short-term indicators. So these are indicators that track shorter-term performance, the percent of stocks trading above their 50-day smooth moving average, which is the number of stocks trading above short-term trend. And that had been weakening really Canada, US, and globally. And also the number of stocks with upward trajectory had started to wane. The leaders certainly acting well, but some of the stuff underneath the surface was a little bit problematic. And this week, things sort of moved a little bit further. So just to jump from a moment, we'll put up the chart of the NASDAQ. This is the NASDAQ rally from March the 20th until last week. And we've had a very significant stair-step higher as the structural themes that have benefited from COVID, like cloud-based computing, like e-learning, like software as a service, have done very particularly well, cybersecurity. And we talked last week about the fact that really we were up at the upper end of this range and that we could get a pullback at any point in time. And sure enough, this past week, we had a number of down days headed into the early part of this week. We bounced into this morning and have pulled back. So far, we're sort of holding the longer term upward trajectory, but there has been a little bit of damage underneath the surface. If we look at the S&P 500, it's quite similar. We recovered off the lows beginning at the end of March. We had a pullback through June, July. We had a second significant move higher, and then over the last week, certainly pulled back. So the question is, what does that mean for the market going forward? What does it mean for our strategy? What changes are we making in the portfolio? So I thought maybe we could talk through those things. So, as you know, what we think is important is to track universes of securities where over time more and more securities are performing well. So having expanding breadth, more and more participation in the market. We highlighted over the last few weeks that outside of the US, the stock market's behavior was less constructive. So in June, 60% of all equities globally were in solid long-term uptrends. And that has been deteriorating since the end of June, which makes sense. We had a very strong rally. And since then, we've moved down to 46% of stocks in uptrends. So you can see about 14% of stocks in the world have started to behave a little bit less constructively. From a short-term perspective, we went from 90% of stocks with upward trajectory to 46%. Now it's not a big problem if you're focused in the strongest companies and the strongest themes, and we've been pretty comfortable that has been the case. But if that goes on long enough, it starts to have an impact. Europe also topped out from a breadth perspective at 64%, so 64% of stocks performing well at the end of June. As we sit today, 48% of stocks, so breadth weakening. So what does that mean? It means that when we take the global universe of stocks that we can focus in sectors and themes, we focused in the US market because the US market had by far the best breadth characteristics, which means lots of buyers under the surface. Now, in the US, it's a tale of different markets. If we take mid-cap or mid-sized companies, Beginning of September, breadth started to weaken there, and same for small caps. Now, for most of you who've been following these weekly calls, you'll know that we have been focused primarily, almost exclusively, in large-sized, liquid, blue-chip companies. Our view has been that we need to own things that are good getting better, where they have solid balance sheets, solid business models, that not only are sound from a balance sheet perspective, but where we can see in the revenue numbers, their revenues are accelerating and improving faster than the streets analysts believed that to be the case. And we had several examples over the last earnings quarter where companies came in way ahead of expectations and very significant increases. The most recent one, of course, was Zoom, which was up 40% the day they reported their earnings. When we look at the NYSE, last week I said some of the short-term indicators are weakening. So this is the percent of stocks trading above the 50-day moving average, moved down from 70 to 50 over the past week. When we look at the percentage of stocks with positive weekly price momentum over the last week and a half, we moved from 74% of stocks with upward trajectory down to 32%. So what does this mean? It means that under the surface, there has been a little bit of weakness, which we've been very, very aware of and very, very focused on. So the S&P over the last week pulled back about 4.6%. Now, we never like to see pullbacks, but they're a natural thing. They have to happen in markets. The question is it a short-term pullback or does it turn into something more than that? At this point, it looks more like a short-term pullback or consolidation. Things maybe got a little bit overbought, but we watch very closely and then we track our individual positions. In the NYSE, as of yesterday, breadth for the NYSE turned lower for the first time. So that's a warning sign that tells us to be a little bit more cautious. The NASDAQ did the same thing, which has been the leadership in the market. And the NASDAQ 100, the biggest technology companies, had a significant reversal over the past week. So what does that mean for us? It means that over the past week, we have stop losses on all of our positions. Most securities have pulled back within their longer term upward trend. That's fine, stocks pull back. Where things have broken down or broken their long-term trend, we've hit our stop losses and moved some money to cash. So that means our technology weight, which was really driving some solid returns from March until September, is lower today than it was a week ago. It also means that there's a little bit of cash in portfolios. It's not, though, just that in a vacuum. So if we take the big companies, the ones that have been responsible for the gains, the FANG stocks are up on average as of last week, about 40% on the year. If you took the S&P 500 without the FANG stocks in it, it was down on the year about 2%. So you can see the big impact. And so when we take a look at the most important companies, Apple over the last week pulled back from 137 to a low of 113 after the split, but still sort of in a long-term uptrend. Amazon pulled back from $3,600 or just below $3,550 to $3,178. We can go through each of them, but the net of it is we've seen correction take place. So for us, that means that we have less technology. It means that we have a little bit of cash. When our breadth models turn down in the pooled accounts that we manage, we put some hedges in the portfolio to reduce our exposure to the market. And one of two things can happen. We can get further price pullback, which wouldn't be an unusual thing in the fall. With a little bit of cash and with less exposure, with some hedges, that means we would have a muted impact in the portfolios. The second thing that could happen is that the market just chops sideways for a few weeks and works off that over ownership. And the third thing that can happen is with all the liquidity in the market, buyers can just come back and buy the dip. So we'll watch for our indicators to show us signs that they're starting to improve. But in the near term, while our indicators are negative, it means we don't make new purchases. If existing positions start to break down, we'll increase our cash position. So we are a little more cautious than we have been. And for the one portfolio that we had set up to be defensive going through a pullback and try and take advantage of it. As of tonight, it's up about 10% over the course of the last week. So that acts as a hedge for people who have that pool in their portfolio. So Pam, there's not a lot else to talk about. The groups that continue to work well, certainly the golds continue to perform well, the basic materials. Certainly the transports are continuing to behave quite constructively. We have seen over the last week some money move from the stay-at-home stocks to the economy reopening trade. And so over the course of the last week, we've reduced our growth stock exposure and we've increased our exposure to sort of the reopening. And those would be the most major and significant changes. So with that, I'd like to open it up to questions.
Thanks, Dave. Could you just walk us through some of the changes that we've made as a team with respect to how we select stocks? As you know, we had some volatility that we dealt with historically 18 months ago. And I think our investors would love to get a sense of how we have evolved our stock selection and if that's impacted the way we look at stop losses and how we're always looking for good companies getting better. So what about the companies that we take out of the portfolio? Maybe you could speak to that.
Sure. Realistically, our security selection process has been the same for several years, right? We use a combination of about 20 factors that we look for in the income and the balance sheet that show that the financial metrics of the businesses are not only getting better, but they are accelerating. And that's what led us into companies like Zoom and Amazon and some of the semiconductor companies that have been so prolific over the last few months. That hasn't changed. The other thing that hasn't changed is that we've always used stop losses, and we use them pretty religiously, like very religiously. We always use them. The one thing that we did do was after the 2018 decline, we felt that declines were coming on more quickly than they had historically because of the amount of money being run by large systematic programmatic asset managers. And so each of the last two declines we've seen in the market have come more rapidly than we have seen historically. In 2018, after the fact, we said that when we went back and did our work on what could have been better, we recognized that if our short-term indicators started to turn down, we would start to get defensive more early, which is why over the last few weeks, I've been highlighting the fact that some of our short-term indicators were wobbling, even though the long-term indicators continue to be favorable. And in that period, we chose to build out the macro portfolio to have a very defensive stance, in fact, to be set up for a market decline. And so those changes are having us become defensive more quickly than we had prior to 2018. Process is the same. It's just like we've dialed up the sensitivity to reflect the fact that these sell-offs can come on quickly. So as we sit, as over the last week, prior to our long-term indicators turning down, we reduced our technology weight across all the portfolios, and then raised a little bit of cash, and then built some hedges into the portfolios. So you're never in the first 3 days going to catch the first 3 days of a decline, but you certainly can protect yourself once a decline gets going. Now, we said last week, realistically, there is a mountain of cash sitting on the sidelines, people who have missed this rally completely. Markets pulling back will bring some of those buyers into the market. The economic data for sure is getting better, but I think what is more likely over the last week, it is money starting to be pulled out of some of those growth stocks that have been so strong to go into companies that will benefit as the economy slowly reopens. And that's caused some turbulence over the course of the week.
Thanks, Dave. Commodities, what's your view on commodities? They seem to be holding up pretty well.
Yeah, so this is interesting. And, we talk all about trying to focus on finding asset classes that are under-owned, that are not well-loved, but that have opportunity in front of them. And equities has been one that we've been very focused on over the last few years. Commodities have been a very low weight in the portfolio. And, you know, it's been kind of for good reason. I'll just try and put a longer term chart of the commodities index up on the board. So you can see here that commodities have been in a bear market going back several years. That's from 2014 to the present. And if we put them up on a monthly chart, you can see they've really been in decline since 2011. And so as most people know, we haven't had a lot of commodity exposure in several years. 2014 for us was what took us out of the energy stocks. And we really have had very little energy exposure ever since. So this is the oil producers index. And a few weeks ago, I highlighted the fact that it's still down 85% off the high. If we look at it today, it looks like it's now off about 100% from the highs back in 2014. So, for instance, while it is almost non-existent in our portfolios as a weighting standpoint, in our macro portfolio, we're short about 10% energy. So this is not a place that we're focused. That's the oil producers. Let's look at the service companies briefly. These are the drillers and the service companies to the industry. You know, it's been very weak and has had a very weak 2 weeks. And you take the very large cap stocks like the Exxons of the world, they've been very weak also. So very low exposure here. What has been more interesting, and we talked about this, has been the golds. And gold as a metal put a bottom in back in 2015 and really started to work its way higher a year ago, June of 2019. If we take a very long-term view, you know, this is probably the beginning, not the end. This is the last secular bull market. You had a bear market that lasted from 2010 through 2019, and we're just starting to break out to new highs. And when we take the gold stocks, they look very, very attractive. And so we do have some exposure here. But as commodities as a whole, we're seeing some improvement in some of the base metals. So companies like Rio Tinto or Freeport-McMoRan, copper companies and iron ore companies. You know, Rio Tinto basically traded sideways for several years and has just recently made a new high. The last time the stock went sideways for several years and broke out, it went up 10 times from, about $9 to $100 over the course of the next several years. So the Canadian market, commodities are important. And if the world starts to believe that things are reopening and there's going to be some fiscal stimulus, then there can be more significant demand for commodities. And because they've been in a bear market for several years, there have been very few new mines opened up. And as you know, it's a declining asset and it can set up a shortage. And so we're seeing lower inventories of copper, for instance. So this is an interesting area, but it's very, very early days. But it is counterintuitive that commodity prices in general are higher today than where they were before the pandemic began. And it may provide an opportunity. Some of these companies have 5 and 6% dividends. So it's quite interesting.
Thanks, Dave. Another question, the volatility index, known as the VIX. How do you use the VIX as part of the macro view on Barometer's risk stance?
Right. So we do use VIX in the process. It's something that we watch quite closely. I'll see if I can pull it up here just quickly. So this is the point and figure chart for VIX. And as you know, we look for trends. And we got a reversal in volatility in summer, and then it followed through over the last week. Now, it hasn't traded as higher like it did in March and February, but it has moved higher recently. Now, what's interesting, and the reason that right now it may be that this correction has less in it than what some people may worry, is when we look at the fact when the market started to sell off last week, the volatility reading started to rise. That's something we watch to say, okay, people are taking note that something's changing. This is a sign that there could be a correction coming. The VIX moved higher for 2 days. And then on the third day, when the NASDAQ fell 4%, actually volatility collapsed. So that's a non-confirmation. If volatility is dropping on a day when the market is going down a bunch, that's the market saying, okay, we think this sell-off could turn into a bounce. And then of course we got 2-day quite significant bounce, and volatility moved up very slightly today, 1% against a weak market. That tells me that it may be that this correction is quite short-lived, but we'll watch and see where we go.
Thanks, Dave. One more question. What's our view on emerging markets and specifically China?
Yeah, so look, emerging markets have been a difficult spot. This is emerging markets over the last week. This is an ETF that owns some of the stronger emerging market companies. This is just the straight EEM ETF. Again, you can see that it has been relatively underperforming the S&P 500. This relative strength line has been dropping, which means that the shares have been underperforming the S&P. Our breadth models for emerging markets have been less favorable. And so as a result, we've had very little exposure. The one area that we have had exposure to was the Chinese consumer. And the Chinese consumer ETF had a very, very good run. We moved out of it a week ago, just with the view that as breadth models were deteriorating, this is a higher volatility security. So we'll see what kind of pullback we get in this, but it's an area that we want to keep in mind. But so far, the breadth readings for China, are a little bit sloppy, and so we're not putting any new positions on.
Thanks, Dave. Do you think that a lot of the volatility that we have seen over the last few days is related to the fact that many investors were on vacation and now they're coming back, or pseudo vacation given coronavirus, and now they're coming back and they're staring at a really uncertain period of time leading into this election? What's your thought on that? I would say September is like a new year.
Okay, people always worry about the fall. They always worry about elections. Market had a tremendous summer, much better than I would have expected. Thank goodness, we have the processes that we have that pushed us into some of these key themes that were so prolific, because, the equity strategies have really had a good go. I think that it is just a fact. If you take, for instance, the NASDAQ, and we look at how it is traded relative to the longer term moving average, as of last week, the NASDAQ was trading 29% above its 200-day moving average. So this is a smoothed average of price, this red line. And that's just means it was really extended. You have to go back to the late 1990s for NASDAQ to have been that extended. And I think the sentiment got really, really overly bullish. And, you could have said it all the way along here, but you never know when you're going to get a pullback until it begins. And it began last week. So look, I think at this point, it's just correcting some over ownership. We'll see whether it's something that persists. So far, when I go through our holdings are hanging in really, really well. And I'll see if I can put this up just briefly. I was looking earlier as to use this as an example. If I put up, for instance, the holdings that are in the key themes that are in the macro strategy, for instance, so we run point and figure charts on all of our securities, and we try to judge pullbacks as to whether it's something within trend or something that's changing. So for instance, this is the First Trust Cybersecurity ETF. It's an ETF that owns companies that are in the software business providing cybersecurity. And the way you read these charts is when price is moving higher, it's in a column of X's. And when it moves down, it's in a column of zeros. So you can see that since March, we've had a series of higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So far, there is it's pulled back from $37 to $34, but no break in the long-term trend. Now, if this were to pull back below the previous low here at 33 to 32, that's a change in trend. Now, if we go through all of these securities, every single one of them has a constructive trend. So what that says is what we're seeing right now is just a normal pullback. There's no change to long-term trend in any of these. And if we go through the portfolio one by one, every single security is just having a natural pullback. So it doesn't mean that it doesn't bother you to see them pull back 4 or 5%. It always does. This is the cloud computing ETF. Higher low, higher low, higher low, higher low, higher low, higher low. It's just like a stair step. And that's exactly what we'd like to see. So we watch that for every one of our securities. If they start to change, we stop them out. But I just think that the market got a little overbought and we needed a little correction.
Understood. Thanks so much, Dave. That concludes our questions for today. And we always appreciate everyone participating and joining us. We will see you guys next Wednesday at 4 p.m. Dave, do you have any last comments?
Yeah, look, first of all, if you have any specific questions, don't hesitate to call us. We are here. Everybody is engaged. The portfolio team is working very hard. Ultimately, pullbacks create opportunities. The reality is that whether it is 2 months from now or 5 months from now, we are likely to get a vaccine. The market does look 8 to 12 months ahead. So it's really important we don't get caught up too much in the news flow. We just have to follow our process. And there will be opportunities as we go forward. And so don't hesitate to call us if we got questions. And we'll be back next week. Thanks very much for tuning in with us.
Thanks, everyone. Have a great rest of your afternoon. Bye.